Stocks our strategists feel are poised to deliver positive returns are featured now in their top stock picks of the week.
What do a utility and a drug company have in common? Well, they're both top stock picks this week. And our strategists, Ryan McQueenie and Nina Mishra, are here to tell us more about them. You have the utility, Ryan, Southern Company.
Yeah, Southern Company, ticker SO. I think if you probably look back over the last few years of top stock picks videos, I'm not sure a ton of utilities would pop out. So that's where I want to start before I get into the specifics of Southern Company. Just the idea of a utility right now after the last few weeks of volatility in the market. I don't think the run of the FANGs and the mega cap tech companies leading the way right now is necessarily over. But after this last few weeks, risk is back on the table for Wall Street. I think if anything, we're aware of risk, and when we become aware of risk again, typically what happens is these defensive stocks, the utilities being one option there, start to look a little bit more attractive. So I think there's a very good chance we start to see more and more investors kind of cycle some money into utilities after having years and years and years of these high growth tech companies really pay off for them. Excuse me. I wouldn't be surprised if the defensive options get a little bit more favor. Excuse me. So Southern Company specifically, gas and electric company. It's the second largest utility in the United States, actually. Around since the 40s, operates in 18 states, huge customer base, 12 subsidiaries, checking a lot of the boxes we're looking for in terms of a quality utility, the size of the company, the stability of the company, and then the fundamentals. 15 times earnings is actually pretty solid compared to its competitors. 5.4% dividend yield right now. If you're going to be doing a defensive play like this, a nice little cash payout is going to make you feel even better about it. If we take a look at the chart, though, we can see over the last 5 years, not really been doing too much, and that's for a couple reasons. I think there hasn't been a ton of interest in the utilities, but they're also the earnings outlook, the trend has not been very positive for SO, but it's a Zacks ranked #1 buy right now, strong buy, so we know that has changed. As we can see, our earnings trend for this year and next year trending upward, and we've seen the stock fare relatively well over those last few weeks of volatility because of it, and I think also because of this cycle into the defensive plays.
Don't they have a good earnings surprise history? Yeah,
as you can see, it hasn't missed here since looks like early 2017.
Okay. Nina, you have the drug company, Johnson & Johnson.
So as Ryan mentioned, people are rotating into defensive sectors now. In fact, healthcare, which is also considered a defensive sector, was the top performing sector of all S&P sectors in the third quarter. And most investors, myself included, we have a lot of exposure to tech stocks, and now there are so many worries in the market, peak in earnings, global growth slowing down, and trade and tariff concerns. So I think some exposure to defensive sectors to have a more diversified portfolio makes a lot of sense.
So this is another good defensive play?
This is another good defensive play. And it's a healthcare giant, very diversified businesses, medical devices and pharmaceuticals and consumer healthcare products. They reported very good results recently, beating on both the top and bottom lines, and they also raised their guidance, and strong sales of their cancer drugs, including blood cancer and prostate cancer, and strong sales of their baby care products in the US. They boosted results. Now, if you go to detailed estimates page, you can see that analysts like the results, and they have been raising their earnings estimates for the company. And looking at the longer term price, consensus, and EPS price chart, you will see it's beautiful. They have never missed in the past 20 quarters. Now, Johnson & Johnson has been signing a lot of deals, which continue to boost their revenues. And earlier this month, they entered into an agreement with Arrowhead Pharmaceuticals to develop gene silencing hepatitis B treatment. And that deal could be potentially worth $3.7 billion. So that will boost revenues going forward. Another reason why I have liked Johnson & Johnson for a long time, it's a dividend aristocrat. They have been raising their dividends consistently for the past about 55 years. And they have also been returning a lot of cash to shareholders in the form of share buybacks. Now it is currently trading at 16.78 times forward earnings, which looks pretty reasonable, and dividend yield, as they have been all raising their dividends consistently, is 2.63%, which also looks pretty good. And for healthcare stocks like Johnson & Johnson, which have a lot of exposure to emerging markets and other international markets, we know that healthcare spending is rising in emerging markets, and it's rising from a very low level. So that remains long-term tailwind for companies like J&J.
So do either of you own either of these?
And I forgot to mention it's a Zacks rank 2, buy ranked stock.
Oh, okay.
But I don't own either.
You don't own either?
I do not.
All right, thanks for that. More stock information on our website, Zacks.com, always there for your review. Get on over to the homepage. That's where all of the information begins. With Ryan and Nina, I'm Terry Ruffalo.